over the last year, as we celebrated 25 years, we took that as an opportunity, a milestone to look back on things that we've learned, how things have gone. I personally am a big fan, have a big interest in financial history, in bubbles. I think when we look back at 2000, that was one of the bigger financial bubbles, the dot-com bubble. Curious how you guys navigated that market, what you think about that with hindsight. And I know one of the big things for the firm and how we got started was both of you had a view that we should steer clear of the most expensive, frothiest parts of the internet bubble when most other people were plowing into that. Uh, Talk to me a little bit about how you made that decision and how it was a benefit for the firm um, coming out of that period of turmoil for markets.
Sure. We were never big believers in this time is different. And that was one of the first times in my career that we had the, 98, 99 internet bubble, as you talked about. But this time is different. And we never really bought into that. And we mixed that less with an opinion that the market was too expensive, although it was clearly very expensive. And using the metrics you help us with today, it's as expensive now as it was then, which we can talk a little bit more about those red flags. But we blended that with the view that portfolio construction should be thoughtful around strategies, not asset classes. And people had diversified allocations in late 99 that were owning lots of different tech stocks. From our perspective, that wasn't diversified. It was in the early days of people reading, David Swensen and others in terms of thinking about what are the underlying risks of different strategies. And one of the things we did day one was develop an asset allocation approach that allocated to strategies, not asset types. And that's one of the few things that hasn't evolved at all for us. And so going into 2000, being diversified, but truly diversified, not because we were bearish, but because we thought that was the right risk manager's approach, turned out to go really well. And so the fact that the market was down in 2000, 2001, 2002, and we lost very little money, if any at all, because a lot of those diversified strategies did quite well in those environments, was just, formative in terms of we had a view and that view worked out really well. And that was just helped build our confidence.
Yeah, and I think the what was interesting, we started our business in February of 2000. The market peaked 6 weeks later, right?
Mm-hmm.
And we didn't see that peak until 2007, very briefly, and then we didn't see it again until 2013. So we went through our 13-year period where the market was effectively in a drawdown 95% of the time, right? We wouldn't have signed up for that day one, right? That wasn't the plan.
Yeah, we would have not launched an asset management firm if we'd known that's what market performance was going to look like.
But in hindsight, the approach that we were taking, being diversified, using an endowment-like approach, using different tools in the toolkit than the traditional portfolio, was the exact right approach to take through those periods of time. Um, I think that we probably made some mistakes, post that period of time, with our 13-year experience of markets being in a drawdown. But the core lessons from that are still very applicable today.
What do you think it says about the culture of the firm that at the time we had the courage and conviction to stick with something that wasn't working in the near term because we thought long term that was best for clients? You looked across Wall Street and you had tons of people who were throwing caution to the wind to chase performance because they thought there was career risk in not doing so.
Mm-hmm.
We took the opposite tact. How did that evolve? How did we think about that? Was that something you only understood with hindsight, or is that something you were cognizant of in the moment?
We were very cognizant of that risk. There were a number of equity managers over the course of the 90s that were, very, very value biased, or hedge funds that were short these high screaming internet stocks. And that turned out to be a massive detriment to their business model. So we took a diversified approach, but we didn't take a dogmatic bet against it approach. As I like to say, and I stole it from a good friend of mine, being diversified means always having to say you're sorry for something, right? So it wasn't like we were short internet stocks or didn't own any of them. We just took a very diversified approach. And so I think that was a little bit more all weather, and that allowed us to not have to buck the trend. We just didn't participate in it quite as much.
And I think it also comes back to the approach is the right approach for our clients, right? So our clients have generated significant wealth. The way you make sure you keep it is compound it at attractive rates consistently over time, right? The way you can make sure you lose it is to have a huge drawdown, right? And we've talked about 50% drawdown, you need to make 100% to get back. The market from March 2000 till end of 2002 was down almost 50%.
Mm-hmm.
If we had a directional equity portfolio, it would have taken a long, long time to get back. And then you bring in the psychological elements, which make it very difficult to stick with something that's underperforming like that. So for our client base, this was the right approach. And that I think is ultimately what we had a lot of conviction in.
Mm-hmm.
How did that experience shape and inform how we think about risk and return? I know most people lead
Mm-hmm.
with return or expected return. We lead with risk and kind of the range of potential outcomes for portfolios.
I think one is that you have to get risk right. You know, what I was just talking about in terms of psychologically, it's difficult to stick with something that's underperforming your expectations. If you have too much risk or a client isn't aware of the risk in a portfolio, um, you're going to have bad outcomes when bad things are happening, right? So ultimately, if we can spend a lot of time upfront describing in lots of different ways what risk in a portfolio might be, or different types of portfolios, and we can zero in on what's the portfolio where a client's going to be able to sleep at night in a difficult period, then seek the most return for that portfolio, we're going to be in an optimal position to actually be able to lean into those things that are weak in a more difficult environment.
Mm-hmm. How we think about that has not changed. Again, I think the fact that our clients were able to weather that 0002 drawdown, weather that '08 drawdown, to be able to take advantage of one of our other core tenets of mean reversion and lean into those drawdowns to take advantage of the back end, was self-reinforcing.
I want to dive a little bit into the psychological or behavioral aspect of managing portfolios.
Mm-hmm.
In finance, certainly a lot of the things that we do are modeled mathematically. I think you can get a false sense of security when a model tells you something that you want to hear. Also, largely dependent on the inputs, too, right? And I think these days we hear a lot about if you had just held XYZ stock from this date until this date, you would have made XYZ returns, but it completely ignores kind of the journey between those 2 points.
Mm-hmm.
And from a client perspective, from an investment perspective, when we think about the behavioral risks inherent in seeing a 50% drawdown and still sticking to the plan,
Mm-hmm.
obviously when you think about diversification, think about limiting drawdowns and allowing clients to actually see their goals, plans, and objectives to fruition, how much value that creates, and just allowing portfolios to compound.
Mm-hmm.
How have you seen that differ to the downside and to the upside? I think on the downside, people are concerned about losing more money. On the upside, people are concerned about not making enough money. And I think that's always just kind of inherent in investing. There's a huge psychological component to it. How have you seen that evolve over time? How have we looked to manage and help with that? And how have we looked to keep the focus on compounding as opposed to chasing outsized returns?
I think on one hand, the first 13 years, or and maybe even a little bit after that, you had clients that were much more comfortable with that diversification type approach, right? Looking backwards, that was beneficial, right? And what's shifted over the last 12, 13 years is that as the S&P has been the best performing thing, and there are these stories of if you held this stock from the low in 2009 until now, you'd be a billionaire, right. It becomes harder to argue for diversification and the merits of that. It really goes back to what are the goals, right? If your goal is to take $100 million and turn it into 2 billion, then you need to be really concentrated and make big bets. If your goal is to take that 100 million and compound it for generations and grow it without the risk of significant drawdown, taking a diversified approach makes more sense. So it still can be the right approach depending on what the client goal is. We tend to not have a lot of clients that are trying to turn 100 into 2 billion right tomorrow, but ultimately, I think it comes back to the goals of the individual client.
Yeah. I think the thing that has evolved is the upside part, not the downside part. Um, as I said, we taking that diversified, thoughtful, risk managed approach, limiting the drawdowns, compounding over time, is something that was in our DNA day one and hasn't changed. I do think what has changed is that capturing the upside. And so, for instance, one of the mistakes we made in '09, I would argue, was not being aggressive enough. That we, stuck our neck out to buy really cheap debt, but we did it on a hedged basis. And what we learned is, you know what, if something's really, really cheap and you want to own it, just go own it. And I think we've done a much better job of that over time. I would also say, and you've seen this in the last 3 years, changes post-pandemic, changes with AI coming in, that there are some pretty big waves, and we want to make sure we've got access to ride those waves and generate real outsized returns. We were able to do that in 2025 in gold and commodities through different managers, that we can generate some asymmetric upside in diversified parts of that portfolio where we're really letting it ride. Certainly not on a portfolio-wide basis, but again, being diversified means doing bits of all of that, not just being conservative.
And I think it comes back to, the Howard Marks quote in terms of, if you can be solidly second quartile consistently, you'll end up over the long run with first quartile, top quartile returns, right? So
Mhm.
the
Top decile.
top decile, right? So ultimately, you don't have to always outperform. What you do need is in that period, some market volatility, right?
Mhm.
And that's really what we haven't seen. I think our returns have still been excellent over the medium term, but it's harder and harder to keep up when the market's up 20% a year. We don't expect that will be the case, in perpetuity. And you even look at this year, right? Coming into this year, the consensus, broad consensus, it was hard to find anybody that was negative about 2026 equity markets. And look how the year's starting. There are a bunch of things that are now headlines that weren't headlines before. Not predicting that it's going to be a bad year in equity markets, but sometimes what happened in the past or what everybody expects isn't necessarily what's going to play out. And having that diversification, we're feeling really good about that in the beginning of 2026. And I think you're starting to see more and more folks that are on board with that diversification when they're less so in a period when the market's up 20-25%.
Mhm.
How do you think about moderating equity beta or equity market risk in those different types of regimes?
Sure. I think it goes back to how we build public equity portfolios. So first of all, uh, that question to me relates almost exclusively, not totally exclusively, to public equity, because what you do on the private equity side is somewhat independent. It's not nearly as independent as I think the world thinks, because it is a benchmark when you're making an investment, and it's often a source of liquidity and/or a benchmark when you're looking to exit the investment. So they're certainly not disconnected. And so, for instance, um, we think that IPO markets, which you've already seen, is doing much better than it was a year ago or 2 years ago. So owning later stage growth equity privately is interesting because of the ability to exit through IPOs. And you've got a bunch, whether it's SpaceX, Anthropic, OpenAI, all sort of teed up for this year. That's not to say we are investing in those three companies, but that is part of the driver. In terms of the risk, our equity portfolios, on average, are like high 0.8, 0.9 beta, and they get that way a couple different ways. Part of it is the one beta of owning index, and we can adjust how much index we own as part of those portfolios. Part of it is a low turnover but active long only part of the portfolio where we tend to be, not exclusively, but tend to be lower beta. That lower beta is because not all the managers are 100% invested all the time. If they've got a lot of good ideas, they're 100% invested. If the market's really rich and they've got a smaller subset of ideas, they can be less than 100% invested. That reduces our risk. Two, they tend to own stocks that trade more idiosyncratically because they think they're interesting stories that have catalysts to make money, but are not driven by the vagaries of the market going up and down each day. And then lastly, managers that can be long and short. Just the fact that they're short means that our net exposure might be less than 100%, and it allows them to manipulate that exposure based on the opportunity set. You know, and things like healthcare, that net was a lot lower. That net's a lot higher today, as that manager is finding more biotech opportunities. So there's lots of ways that builds into the portfolio construction. Some of it's us with the allocation, but a lot of it's the manager driven, where we've got confidence in those managers, and the managers are executing based on those market conditions.
And it Europe's an interesting one in that you can make a coherent case for why European equities shouldn't be attractive over the medium term, writ large. That said, there are a lot of great businesses in Europe, and many are peers to names in the S&P 500, right? But quality stocks in Europe have really underperformed over the last 24 months. And that to us is an interesting way to own something similar, right, at a more attractive valuation. And that, so for us, the waterfall would be, do we want to own it passively? The answer is no. Do we want to own it actively? We've found folks that we think are really high quality, that are focused on quality oriented businesses that happen to be based in Europe but are global businesses. Every 100 times out of 100, I'd rather own that global peer at a much discounted valuation than
Especially if you're
US.
not worried about what next quarter's performance is going to be and you're not chasing it. The other thing, and I give you a lot of credit for this, Rob, is for how we think about that across the whole portfolio, right? What does fixed income look like today, now that interest rates are higher than they were 3 years ago when you joined, and the attractiveness of stocks versus bonds? How do we think about returns that can be generated in diversifying strategies, given increased volatility, increased corporate actions, complicated, credit, capital structures versus fixed income? And so thinking about that on a relative basis, and it's really driven by the work you do, helps us think about risk reward across the portfolios as well.
Yeah, I mean, I think every choice is a relative value trade, right? Do I own equities or do I own fixed income? And I think one thing that we've said a lot internally, that I think we've been internally consistent about, is it's not really about being right
Mm-hmm.
in investing, right? This is a game you get to play over and over again every day, and it's about getting the odds in your favor. And if you can stick with that plan for long enough, good things will happen. And I think people get caught up a lot in like, is this right or wrong?
Mm-hmm.
And I think that's not the right way to think about it, because it's not a single coin flip where you need it to be heads.
On the investment team, we want to be rigorous. We want to be intellectually curious. You want to be looking at ideas all the time, not just doing research on what you think is interesting, but sort of doing research on everything. It doesn't matter if we love a manager in the space. And to Todd's point, making sure we own a manager, not three managers in that space, to limit the diversification. But by doing that, you then need to be meeting other managers in that space all the time, so that you're constantly force ranking those best ideas. That's something we've always thought about. And I think as our research team has grown, notwithstanding the portfolio getting modestly more concentrated, is something we've been able to do more and more and more. And it's allowed us to populate the portfolio, or try to populate the portfolio, with these really interesting ideas, regardless of market conditions.
And I think the another thing that is different today than it was, in late 99 or early 2000, is that, um, you know, when we first started applying an endowment type portfolio to families, the diversification largely came from hedge funds, right? And we built private equity and real estate and real asset exposure over time, but given the nature of those types of investments, it took a while to get exposure to those underlying categories. So the diversification that worked really, really well was generally on the hedge fund side. The number of tools in the toolkit today relative to 25 years ago is exponentially higher, right? There are so many more things we can do more creatively, and scale is part of that, right? We can bring scale to the table and set up, bespoke structures with individual managers that are specifically the exposure we want for our clients at an attractive fee base, which reduces the reliance on one tool, which was hedge funds, right? So hedge funds as a core of what we do has shrunk over time,
Dramatically,
and
actually, from 25
dramatically.
years ago. Yeah.
So it and to the point where it is a tool, but it's not a tool that we're overly reliant on today. And there are so many more other categories that we're doing interesting work on, that those are the things that are the most exciting on a moving forward basis.
On that front, I think right now is one of the more interesting times, especially in public equity markets that I can remember. If you think about the S&P or the ACWI at a top line level, it's like 2% off the all-time highs.
Mm-hmm.
But we've very rarely had as many stocks underneath the surface, seeing single day declines on the order of 5 to 10%.
Mm-hmm.
A lot of this is tied up in what if questions about artificial intelligence. But I think it's probably a good point to talk about active versus passive.
Mm-hmm.
When markets are really expensive and when concentration is growing within a market, it's tough for active
Mm-hmm.
management to keep up with the passive index. Right now, we're kind of seeing that, if not unwind, at least plateau and
Mm-hmm.
falter with how much of the index is in the 10 largest names.
Mm-hmm.
What are some of the things you're most excited about and seeing underneath the surface from active managers where there's a ton of value to be captured?
I would just highlight first that I think active and passive is cyclical. And to your point, I think we have probably come around the peak of that cycle. And there's lots of reasons. Part of it is valuation. Part of it is what's driven that concentration in AI and the hyperscalers and what's, the Mag 7. And we can, everyone is more or less familiar with those phenomenons and what has changed. I think the fact that that has happened is good for us as it relates to finding those smarter, interesting, more active ideas, that I think there is a multi-year secular tailwind driving that going forward. I'll let you dive into individual ones though.
Yeah, I think one is that's topical today is credit, right?
Mm-hmm.
So private credit, direct lending, is seeing some significant weakness and concern. That's an area that we avoided, right?
Mm-hmm.
We were not investors in that category on
Right.
behalf
The
of our
private credit
clients.
stuff we did was very idiosyncratic.
Yeah, we did no general market, middle market direct lending
In the U.S.
in the U.S. for a long time, right? More recently, we've started to dip our toes in,
Mm-hmm.
and that's because I think at the time when it was becoming popular, it was effectively you were competing on rates and covenants against everybody else, and it was effectively a commodity, right? And the risk return skew was not attractive. And I think you potentially could see the other side of that in the near to medium term, right? And you're starting to see that weakness related to blowout, et cetera, today. There's lots to do in the credit markets in a more volatile environment. Again, the lack of volatility on the equity side has been evident on the credit side. But we've talked for years about the distressed opportunity, and it never actually materializing at a market level. But there are lots of microcycles ultimately in credit and areas of stress and distress that our managers can take advantage of. I think that's going to be a more fruitful area going forward. Another one would be real assets ultimately. In this, is going back to the deglobalization theme. Reinvestment in U.S. infrastructure is something that has a real attractive secular potential tailwind, and that's something we want to have exposure to. We have in lots of different ways, and we've built that over the last couple of years, kind of ahead of the trend, I think, a little bit, but I think our clients will really benefit from that over the medium term. And then at the other end of the spectrum, things like biotech, right? We were early in biotech. We'd rather be early than late, right? And we saw weakness for a couple of years, but we're now really starting to turn the corner. And the amount of innovation that's happening in the biotech space, AI does play a big role in that.
Contrarian story, right? With people talking about the FDA and other things. It's not. I still think we're early.
Yeah, but it was one of our best performers last year, right?
Mm-hmm.
So that's one where I think that has legs, and ultimately the innovation that's going to happen based on all of the work that's been done on the human genome, and ultimately the AI applications that go on top of that, will mean that there are more and more drugs to solve various diseases and issues, that are released more quickly than they have been in the past. So having that exposure in the ground today is something that we're really excited about over the next call it 3 to 5 years.
Yeah. I'd also just add real estate writ large. Real estate was one of the few asset classes that performed in line with what your finance textbooks would say. As interest rates came up and discount rates came up, cap rates came up and prices came down. Equity markets kept hitting new highs, but real estate assets came in. And so whether that's disruption in capital structures, the ability to buy core real estate tax efficiently in long-term holds at interesting returns, nichier strategies that are earlier, like industrial outdoor storage and things along those lines, has just been have worked well, and I think are things that, or I know there are things that we're still very optimistic about.
It's a fascinating time period. I think there are a lot of parallels that can be drawn to
Mm-hmm.
99, 2000. Certainly, they're not mirror images of one another, but I think the dominant theme of a technology with transformative, disruptive potential has gripped markets really
Mm-hmm.
since November 2022 when ChatGPT was released. I mean, AI isn't necessarily a brand new technology. People have been researching this for decades, but I think actually having an app in your hands that lets people experiment with, use, and make a conceptual belief more tangible is very apropos of what we saw in the late 90s, early 2000 with the internet and what that meant for the distribution of information. I think today what we're talking about is even bigger than that, right? With the potential to replicate human intelligence.
Mm-hmm.
It's kind of fascinating if you think from 2022 through 2025, the actual ultimate form of artificial intelligence was largely unknown.
Mm-hmm.
And I think with that gap or with that chasm in knowledge and foresight, people were able to paint really rosy pictures of what that meant for the future. Interestingly, over the last, call it 3 months, as we've gotten more and more tangible examples of what artificial intelligence can actually do, people have become bearish on what it means for the outlook for the macro. Um, will artificial intelligence actually become a reasonable substitute for labor? What does that mean for how the economy and financial markets behave and how they react? What does that mean for the role of government and its ability to tax and have transfers? There are just so many questions that are now forced upon us in a way that they weren't for the last 3 years when we
Mm-hmm.
could paint a very, very rosy picture.
So you do a good job in that vein of getting us to think about these Gartner hype and disappointment cycles. Where do you think we are in those cycles?
Where do I think we are right now in those cycles? I think we're probably at the first peak before we kind of have a realization that actually adopting artificial intelligence
Mm-hmm.
in a way that can sustainably and broadly replace humans,
Mm-hmm.
we're probably not quite there yet.
Right.
I think the poster child for this right now is software, enterprise software. There's a belief that Claude Code, OpenAI's Codex, will, in the very short term, potentially be able to upend and replace software at an enterprise level.
Mm-hmm.
And I think just because you can do something doesn't mean that you should or that you will. I would think about cybersecurity as an example, right? We might be able to build something that can reasonably approximate cybersecurity internally, but the reputational risk, career risk of doing so is probably too much at this point. If you're using CrowdStrike and you get hacked, that's one thing. If you're using BBR Strike and you get hacked,
We would be no
that's
risk at all.
probably a bigger issue.
Right.
And I think there's just some impediments and inertia to full scale adoption that means that might take longer than people expect today. I think if you go back to 2022, people might have thought that artificial intelligence would be a reasonable replacement for human labor at scale in 10 years.
Mm-hmm.
Today, if you talk to some people, their time horizon might be as soon as 6 months.
Mm-hmm.
And I think you're probably somewhere between 6 months and 10 years. That doesn't mean that people are writing down the terminal value of businesses that they think can be replaced.
There's a real argument, I think, on data is foundationally important to any AI sort of application, and if you think about the state of most companies or business data, it's not in a state today to be able to fully maximize the value.
Just to try and switch gears a little bit, one of the things I've seen evolve over the last 25 years is the impact of geopolitical events. Because for me, it feels like it might matter longer term in value, but it certainly doesn't drive, historically, I would say they're buying opportunities, but they're not creating the buying opportunities anymore.
I think the thing you need to be careful about is it feels like the world has become desensitized to some of these issues, right?
Mhm.
And in some ways the scale of the issue is getting bigger and bigger.
Mhm.
There's a point where it does matter,
Right.
right? And ultimately that all circles back to not making a big bet one way or the other,
Mhm.
being diversified, having exposure in different areas that are going to perform differently in that type of environment, and not taking too much risk. So the fault, I would say, in looking at that and saying geopolitics don't matter would be to have too much risk on at the time where they actually do matter.
So we've talked about things that were really risky 25 plus years ago when we started. The geopolitics stuff we just covered, valuation being as high now as it was then. Talked about, that was the internet and online. Now we've got AI and big technological shifts. I'm the glass half empty guy. I think that helps on the investment side. We've talked about how managing risk first, and you do it through being diversified. Are you more optimistic or pessimistic today? I'll answer the question last about like what keeps me up at night and keeps me positive. But what are you thinking on a go forward basis? Or what are some of the big
Optimistic or
risks we're not
pessimistic
thinking
about what?
about markets, and are there things we're not thinking about that are going to have big positive or negative impacts?
I don't know that I would say I'm optimistic about markets, but
Mhm.
I'm very optimistic, as I referenced earlier about the opportunity set, right?
Mhm.
To find interesting things to do,
Yeah.
right? And I think this plays right into our skill set, right? When the easy game is when the S&P is doing the best of
Mhm.
anything else, right? And I think that that might not be the case over the next 5 to 10 years. Maybe it is, but maybe it isn't.
Mhm.
And if it isn't, we're well set up for that, and that's
Mhm.
what makes me optimistic.
I think it's time horizon dependent. I
Mhm.
would say in the short term, I am, I won't say pessimistic, but concerned.
Mhm.
We have artificial intelligence, which I think in the near term is going to cause a lot of angst and consternation.
Mhm.
I think fortunately, markets often give you more than one chance to buy.
Mhm.
And if we think about the Gartner hype cycle that we talked about earlier, I do think that we will get a reset in AI valuations at some point in the next, let's say, 2 years. But longer term, I'm a believer that artificial intelligence is going to be hugely transformational.
Mhm.
And I think over the long arc of history, I'm a believer in human ingenuity and innovation. So I would say in the next couple of years, I would be very attuned to the risks. But I think if you're looking out 3, 5, 10 years, there's going to be a ton of opportunity, and that tends to accompany technological disruption and innovation.
Yep. Okay.
And how does that translate again to client portfolios? I think it's not being over concentrated in those themes, maintaining the right level of risks in portfolios, rebalancing things that have actually done well over time,
Mhm.
adding to some areas that haven't done as well. Um, and I think we have portfolios that can muddle through those times,
Mhm.
and again then take advantage of the weakness that could come, right? It's not guaranteed to, but that again is an environment that I think plays right to our strengths.
I don't think anything's ever an end state, right? It's the how quickly does it transition? Can you live through or take advantage of that transition? And then when there's a dislocation, ride the upside on the back. I mean, you got to think longer term through that. And so it's things we should be worried about, and then things we don't even know we should be worried about yet, not on our bingo card, as you say. Um, and I'm confident that our approach allows us to weather that and monetize those opportunities.